The equity markets, which we're familiar with, came into being in the 19th century. And they were created in order to finance railways and railroads in the first instance. And these were very capital-intensive projects. And the capital that they employed was also very specific to the activities concerned. If you build a railway, there's really not very much you can do with it, except run trains on it. And the savings to finance that was collected in the 19th century in relatively small quantities from fairly large numbers of reasonably well-off individuals. That's how equity markets began, and the purpose of markets was really to provide a degree of liquidity to these individual investors. The model which was created there was applied subsequently to resource companies, and then gradually to manufacturing businesses. So if I look at the largest companies by market capitalization back in 1900, by enterprise value, it looks something like this. You'll see there are actually 5 resource companies on it, Standard Oil and 4 miners of various kinds. Carnegie Steel, which a couple of years later would be merged into United Steel or US Steel, and would actually become the largest the largest company in the world by some distances there. The next manufacturing company is J.P. Coates. Anyone remember what J.P. Coates did? It's Bread, absolutely. It's a British company that was world dominant in the provision of sewing thread. Quite hard to believe that that's as big a business as it then was. But it was. American Sugar, name self-explanatory. Tabac Regie, continental European manufacturer of cigarettes. Solvay, European chemical company. So you have railways, railroads, and you're adding resource companies and manufacturing businesses to it. And that model was the one that was used essentially to finance the manufacturing corporations that came to dominate Western economies for most of the 20th century. So if I take the very first Fortune 500 list, which was compiled in 1956, and look at the top 10 companies on it, it looks like this. So you'll see that 9 of the 10 are actually manufacturing companies. The one which is the current constant survivor in all of this is actually ExxonMobil, or Exxon, as it then was, having been Standard Oil in an earlier manifestation. 3 of them are car companies, Ford, General Motors, Chrysler. 3 of them are steel companies. Again, a couple you've probably forgotten now what they did. Armour, which was the world's largest food manufacturer based in the US. DuPont, chemical company. And of course General Electric. It's hard to say what it was, but it was then still basically an electrical company. So by that period, manufacturing companies have become completely dominant at the top of equity markets, at the top of the industrial scene. If I take that equivalent table now, it looks very different. It looks like this. You'll see that on the 10, there's actually one manufacturing company, Johnson & Johnson, and it's not a very typical manufacturing company, or it's not a very traditional manufacturing company, in the sense that it's not the kind of company that employs the people who worked in steel or car plants and went home at night to rest and shower after a day's hard physical labour. Several of these companies many of these companies didn't exist in 1956. Berkshire Hathaway did, but not in anything resembling the form we now know it. J.P. Morgan, the bank, was there, of course. But the others are all relatively recent creations, and many of them didn't exist even 20 years ago. But more importantly than that, they're very different kind of companies. And irrelevantly, they're not capital-intensive companies. If I take the two companies at the top, Apple and Alphabet, they have market caps in the range 500 to 700 billion, depending on what day of the week it is, itself somewhat significant. But their operating assets account for only about 5% of that. Apple and Alphabet each have operating assets of between 20 and 30 billion. Almost all their market capitalization is accounted for by their brands, their intellectual property, the expectation of future profits from the efforts of the people who work there. They don't employ many people either. In fact, if I'd gone back to 1956, we'd have seen a picture in which the largest companies by market cap were pretty much the same as the largest companies by employment. These were the world's largest employers, as well as the largest companies. It isn't like that anymore. If I look at the largest companies in the world by employment, it looks like this. The biggest by some distance is Walmart. Half the ones on that list are actually Chinese companies. The second largest is Foxconn, which you will know is basically a Taiwanese company, large operations in China, and it makes much of the stuff that the companies on the previous list either sell themselves or sell products that are used on. Some of the others you probably won't even recognize. There is only one manufacturing company on that list, which is what is now the world's largest car maker, which is VW. Yummy brands you may not recognize, but you might recognize it if you call it Pizza Hut or Kentucky Fried Chicken or Taco Bell, which are some names of trades. Tesco, you have another retailer. Compass Group is a big outsourcer and facility provider. Deutsche Post, the world's largest logistics company. All of these are now service businesses, which basically are suppliers of labour and provide minimal value added in general to the labour use. So you can see the way in which the nature of business has changed. It's much less capital intensive than it was. The businesses that are the dominant businesses in the world economy today are the kind of businesses we were looking at earlier, the knowledge businesses. There are labour-intensive businesses, but they're labour-intensive businesses which are essentially providing services to these kind of companies. In other words, the nature of business has changed very fundamentally across the time, across the period since the development of initial equity markets. And the capital markets, which we have changed in line with that. That's a question that I want to raise really for you this afternoon. Today's leaders are neither labour nor capital intensive. And more than that, part of the reason they're not capital intensive is that they're not capital intensive, but it's also that such capital as they do employ doesn't have to be owned by the business concerned, and mostly isn't. When I talked about railways and railroads, the capital was very specific to the project concerned, and the same was true of Ford or of Bethlehem Steel. The capital employed was in building steel plants or car plants. But such capital as Apple or Alphabet employs is basically buildings, data servers, offices, a piece of Apple retail premises. So the company that operates them doesn't have to own them, and very frequently it doesn't. Amazon has quite substantial operating assets. There are large warehouses, logistics operations, which mostly it doesn't actually own. So we've separated, as it were, the company from the operation of providing capital to that activity. But, I've always been amused by the discovery that Apple's flagship store in London, Regent Street, is actually jointly owned by the Queen and the Norwegian Sovereign Wealth Fund, which is kind of how the nature of ownership of that kind of capital has evolved. So that's what modern business is like. And I'm asking how have markets in the process of capital allocation changed in response to this? Well, of course, capital markets have evolved enormously over the 20th century. And I rather treasure this quote because there is so much that you can actually pull out of it that you want to ask, that I find I want to ask questions about. It's from the 1980s, and it's claiming the success of the securitization of the securities regulation, which began following the Wall Street crash and the Great Depression, with the creation of the Securities and Exchange Commission and the whole regulatory structure that organised modern capital markets. It's the criteria he has for self-congratulation that I think are interesting. What was wrong 50 years ago was not so much that the nation's securities markets had done so much damage to the real economy. What was wrong seemed to be that they were demoralised. And today, in 1984, he said, they were by far the best capital markets the world has ever known. But what did he mean by the best capital markets the world has ever known? The broadest, the most active and efficient. Except by 1984, market efficiency meant something different from general economic efficiency. Market efficiency had taken on the technical meaning of incorporating all available information, which we know is today meant by the efficient markets and efficient market practices. And the fairest. Were capital markets meant to be fair? We talk quite a lot today, even today, about fair and efficient markets. In Britain, we've just had a review of Fair and Efficient Markets review, it was called. Where did we get this idea of fairness from? Why do we equate fairness with efficiency? What we ought to be talking about, I suggest, is markets that are efficient at performing the fundamental process of capital allocation and evaluation. And that's what we need to assess capital markets in relation to. So I've talked a bit about the way that business has changed over these years, and the way in which business has become much less capital intensive than it was, and how, as it were, the traditional Marxist categorization, in which there was a plant that a capitalist who owned it, and workers who went every day to provide their labour in that plant. A model which did, to some degree, still describe the car plants or the steel plants of the 1950s. It doesn't apply to Google or to Amazon or to Apple in the same kind of way. That's a model which we had there. Let's look. Today we have, in a sense, capitalism without capital. Let's look at what the actual capital stock of a modern economy is. I've taken the figures here for 4 countries, the large Western economies of UK, US, Germany and France, and I've added New Zealand at the end, for which you will see New Zealand is not very out of line in structure with these other major economies. And the striking thing about this slide is
is if you ask where the capital of a modern economy is found, the answer is it's in residential property. Housing accounts for about 60% of the value of the capital stock in Britain, France, New Zealand, slightly less in Germany and the United States. But it's still the dominant element in the capital stock of all these countries. And then there are three other broad categories that make up the rest. There's commercial property, there's infrastructure, and slightly smaller than either of the other two categories, there is business investment. So that's what capital allocation today looks like. It's mainly about housing. There are three other broad categories, and business investment is actually the smallest of the three. So that I've called it capitalism without capital. And it's also capital markets without capital raising. If I look at equity markets in the UK and the US over the last couple of decades, I discovered that net equity issuance has been negative, not positive. By that I mean that the amount that's been taken out of markets through share buybacks and through acquisitions for cash is larger than the amount that has been raised in IPOs and rights issues. And if I go back to the companies that were on my slide of largest companies by market cap, Apple, the total amount of public market equity Apple raised was $100 million, which it raised on its IPO way back in 1980. Google never raised any net equity at all. The only one which did raise significant equity at rotation was actually Facebook, which raised $16 billion and said rather engagingly in its prospectus that it had no idea what it wanted to do with the money. The big investor on that list, of course, is ExxonMobil, which is by far the largest investor in the Western world. But it's a very long time since ExxonMobil has raised any new equity. Not only has it not raised new equity, but it has engaged pretty extensively in share buybacks. And today, the value of ExxonMobil shares held in Treasury is actually greater than the total value of ExxonMobil's tangible assets. None of these companies are in this sense dependent on external equity markets. None of them have in this sense used external equity markets. And the listed company sector, taken as a whole, is cash generative, not capital raising. Indeed, when companies do make IPOs, it's typically not to raise fresh capital for investment in the business. It's to provide a liquidity event for early stage investors and employees. That's not an unimportant function, but it's a very different function from the traditional role in which companies like General Motors would come to equity markets to raise capital. So the change in this sense in the structure of physical capital stock to focus on housing is reflected in the patterns of household wealth as well. But two big things I want you to take away from that particular slide and that particular group of figures. The first is that household wealth is as follows almost inevitably from the dominance of housing in physical capital stock. Household wealth is predominantly housing wealth. Net housing equity accounts for about 40% of the total household wealth of these countries. It's obviously less than the proportion of housing in the total capital stock because we have to offset mortgages against but in most countries, mortgages are only 30 to 40% of the net value of property. The significance of the mortgage rate perhaps erodes over time. Most savings are now in long-term savings channel. The Germans remain an exception to this rule, tending to keep money in deposits. But importantly, except for the United States, long-term savings are almost entirely institutionalized. New Zealand, again, seems an exception to that. But in other countries, I'm kind of surprised by that. Perhaps people can help me through it. It may be to do with the structure of your pension arrangements here. In France, Germany, the United Kingdom, funds directly held in securities are relatively small in proportion to the total. Most savings are institutionalized. And that, for me, changes fundamentally the nature of the capital allocation processes. Most savings are going through either large institutional fund managers, BlackRocks, Vanguards, Fidelities, Capitals, and the like, or they're being held in pension and superannuation funds of various kinds, some of which are outsourced and some of which are managed internally. Now, if we take all this as a whole, what does it actually mean? First of all, the provision of capital to business remains important, but the point at which the provision of capital to external capital to business is important is essentially at the pre-IPO stage, or at the stage before companies reach the size and scale at which they could even contemplate listing. Opportunities for equity investment, providing fresh capital for investment in business, and investment now largely means covering the operating losses of start-up businesses rather than funding new plant and machinery. That's where the requirement for capital in business is concerned, and is mostly in what we would now describe as the private equity space, although I prefer to think of it as venture capital, which is kind of where private equity began before people discovered that they could get the kind of fees appropriate to venture capital by engaging in buyouts of established businesses as well. So there's a private equity venture capital requirement that is directed more at the startup business and less at the financial restructuring, still less at the financial engineering that involves taking companies out of public markets and then flipping them back after massaging their earnings for 2 or 3 years. One of the great paradoxes of private equity, it seems to me, is that at its best it is very, very good, and at its worst it is horrid in its effects on actual business performance. And there is quite a lot that falls into each of these extremes. But if one looks at that composition of physical assets, one sees that looking ahead, it's going to be the case that other categories of asset are every bit as important as traditional business investment in terms of destinations for long-term funds. That means that non-commercial property, non-residential property, and infrastructure assets are very substantial asset categories requiring the allocation of long-term funds. And that housing is actually so large that the traditional method of housing finance, which was essentially the deposit channel taking people's short-term savings and turning them into residential mortgages, there simply aren't enough deposits around to cover the potential requirement for funds So we need to be thinking about asset management in a much broader sense than the focus of so much of the industry today, which is on essentially trading in public equity, would imply. Trading in public equity is frankly almost irrelevant to these underlying processes of capital allocation. So what is capital allocation looking forward? For me, the functions of asset managers are essentially twofold. One is, we can describe as search, looking for new investment opportunities in all of the areas I've been describing. Looking for promising new businesses, looking for promising infrastructure projects, looking for opportunities for commercial property development, and finding ways of channeling long-term savings into that. And the second function of asset managers is stewardship, enhancing the value of existing assets, or at least sustaining the value of existing assets. And the asset managers of the future are going to have to do both of these things in order to find opportunities for capital allocation, manage the capital allocation process, and generate appropriate long-term returns for their investors. So let me take these two headings, search and stewardship, and elaborate just a little what I mean by them, and the kind of change it seems to me to mean for the role of the asset manager. First of all, if we ask what asset managers today are predominantly engaged in doing, it is the analysis of secondary markets in debt and equity. And that's a product of what I've described in my book, and those of you who heard me last year will have heard me talk about, which is the process of financialization by which this industry has become more and more inward-looking and more preoccupied with itself. We need to move away from that to understand better the needs of both the users of capital and the providers of capital. That means restoration of a housing finance system, which is based more on effective underwriting of the finance which is being provided, rather than financing which is being driven by the question of whether the loans that are being made can effectively be sold on in secondary markets through securitization. And that means, in my mind, a system that uses credit scoring algorithms but is not exclusively driven by credit scoring algorithms. One of the things we keep learning so far, at least, about the application of artificial intelligence is that whether we're talking about lending or medical diagnosis, the combination of the skilled professional and the algorithm typically does rather better than either the algorithm or the skilled professional on their own. And that's something we need to apply here. We also need to look at ways in which long-term capital from pension funds, insurance companies, and other institutions can be channeled into the provision of housing finance. Secondly, we need a knowledge of business, which involves the capacity to identify and nurture promising new businesses. That importantly means regulatory reform that makes or removes many of the obstacles that are at the moment to people who are marketing asset management services, to provide frequency of valuation and volumes of liquidity that are far in excess of what represent the needs of the underlying users for frequent valuation. It means the ability to undertake infrastructure project appraisal and management. there has been quite a lot of attention devoted in the asset management sector recently to discussion of infrastructure and finance. But much of it is around what I describe as development of funny financing structures, complex financing arrangements, and relatively little in terms of appraisal of the underlying quality of the infrastructure investment themselves. And I come up with a long list from Britain. I suspect there may be an equivalent list in this country as well, of infrastructure projects which should never have been undertaken, or should never have been undertaken at what it turned out they cost in the end. We do need a good deal more infrastructure in all our Western economies. But my rule of thumb in Britain is if a project would be opened by the Queen when it's finished, it's one you ought to look very carefully at before you put any further investment into it. And I think the tendency of both political and financial market developments to want to promote grandiose projects at the expense of the piecemeal infrastructure improvements, which can do a lot more to make our lives better. And finally, in the non-residential property sector, there are a great deal of extensive property management skills around at the moment. But this isn't, in my perspective, combined with effective financial appraisals that would enable greatly increased additional finance that ought to be coming from long-term investors to these kind of projects to be effectively deployed. So we need to get better at search in this whole variety of areas. But we also need to get better at stewardship. This is taking existing assets and ensuring they're managed better. And that relates both to the established businesses, which, as I described, are characteristically not in any important sense dependent on capital markets. And if they're not dependent on capital markets, that is the important implication that corporate governance, in its broad sense, is not, as it were, an add-on to the asset management function. It's a central part of the asset management function. But ensuring that businesses have effective strategies, effective succession planning, and the like, is what is needed in order to generate underlying returns for investors in the long run. I describe it as an understanding of corporate strategy, which permits the integration of governance and investment activities. When I did work on equity markets review for the UK government 4 or 5 years ago, I was repeatedly told by asset managers about how closely integrated their corporate governance activities and investment management activities were. My experience was that this was very rarely true, and that it was exemplified for me by one meeting in which I realized that the CIO and the head of corporate governance were actually meeting each other for the first time at that particular meeting. We need to get better at the review and renewal of infrastructure assets. This is a kind of expertise which we don't have at all in the asset management sector at the moment. And we need to understand better the dynamics of development of property portfolios. In other words, the kind of skills which, in my view, the asset management sector will require going forward are significantly different from the kind of skills in terms of the understanding and analysis of secondary markets, which have been the historical focus of asset managers. It's a very different world, I think, from the one we were in the 20th century. It's a difference which follows in large part from what I've been describing in terms of a change of the nature of business over that period. And it's one which needs to be transitioned to if we're actually to fulfill the requirement of generating the kind of long-term returns that savers need